And we discussed a lot last time about market, how the market operates. Today, we are going to discuss about financial markets. What is a financial market? Financial market is a broad term describing any marketplace where buyers and sellers participate in the trading of assets such as equities, bonds, currencies, and derivatives. Financial markets are typically defined by having transparent pricing, basic regulations on trading, costs and fees, and market forces determining the prices of securities traded. Some financial markets only allow participants that meet certain criteria, which can be based on factors like the amount of money held, the investor's geographic location, knowledge of the markets, or the profession of the participant. Financial markets can be found in nearly every nation in the world. Some are very small, with only a few participants, while others, like the New York Stock Exchange and the forex markets, trade trillions of dollars daily. Most financial markets have periods of heavy trading and demand for securities. In these periods, prices may rise above historical norms. The converse is also true. Downturns may cause prices to fall past levels of intrinsic value based on low levels of demand or other macroeconomic forces like tax rates, national production, or employment levels. Information transparency is important to increase the confidence of the participants and therefore foster an efficient financial marketplace. Whenever someone talks about the stock market as a place where equities are exchanged between buyers and sellers, the first thing that comes to mind is either the New York Stock Exchange or Nasdaq, and there is no debate over why. These two exchanges account for the trading of a major portion of equities in North America and worldwide. At the same time, however, the New York Stock Exchange and Nasdaq are very different in the way they operate and in the types of equities traded they are in. Knowing these differences will help you better understand the function of a stock exchange and the mechanics behind the buying and selling of stocks. The location of an exchange refers not so much to its street address, but the place where its transactions take place. On the New York Stock Exchange, all trades occur in a physical place on the trading floor in the New York City. So when you see these guys waving their hands on TV or ringing a bell before opening the exchange, you are seeing the people through whom stocks are transacted on the New York Stock Exchange. The Nasdaq, on the other hand, is located not on a physical trading floor, but on telecommunications network. People are not on the floor of the exchange matching, but buy and sell orders on behalf of investors. Instead, trading takes place directly between investors and buyers or sellers who are the market makers through an elaborate system of companies electronically connected to one another. The fundamental difference between the New York Stock Exchange and the Nasdaq is in the way securities on the exchanges are transacted between buyers and sellers. The Nasdaq is a dealer's market, wherein market participants are not buying from and selling to one another directly, but through a dealer who In the case of Nasdaq, it's a market maker. The New York Stock Exchange is an auction market wherein individuals are typically buying and selling between one another, and there is an auction occurring. That is, the highest bidding price will be matched with the lowest asking price. Each stock market has its own traffic control police officer. Yeah, that's right. Just as a broken traffic light needs a person to control the flow of cars, each exchange requires people who are at the intersection where buyers and sellers meet or place their orders. The traffic controllers of both exchanges deal with specific traffic problems and, in turn, make it possible for their markets to work. At the Nasdaq, the traffic controller is known as a market maker, who we already mentioned transacts with buyers and sellers to keep the flow of trading going. At the New York Stock Exchange, the exchange traffic controller is known as the specialist, who is in charge of matching up buyers and sellers. The definitions of the role of the market maker and that of the specialist are typically different. The market maker creates a market for security, whereas a specialist merely facilitates it. However, the duty of both the market maker and the specialist is to ensure smooth and orderly markets for clients. If too many orders get backed up, the traffic controllers of the exchanges will work to match the bidders with the askers to ensure the completion of as many orders as possible. If there is nobody willing to buy or sell, the market makers of the Nasdaq and the specialists of the New York Stock Exchange will try to see if they can find buyers and sellers and even buy and sell from their own inventories. One thing that we can't quantify but must acknowledge is the way that the companies on each of these exchanges are generally perceived by investors. The Nasdaq is typically known as a high-tech market, attracting many of the firms dealing with the internet or electronics. Accordingly, the stocks on this exchange are considered to be more volatile and growth-oriented. On the other hand, the companies on New York Stock Exchange are perceived to be more well-established. Its listings include many of the blue-chip firms and industrials that were around before our parents, and its stocks are considered to be more stable and established. Whenever a stock trades on the Nasdaq or the New York Stock Exchange, is not necessarily a critical factor for investors when they are deciding on stocks to invest in. However, because both exchanges are perceived differently, the decision to list on a particular exchange is an important one for many companies. A company's decision to list on a particular exchange is also affected by the listing costs and the requirements set by each individual exchange. The entry fee a company can expect to pay on the New York Stock Exchange is up to $250,000, while on the Nasdaq it is only $50,000 to $75,000. Yearly listing fees are also a big factor. On the New York Stock Exchange, they based on the number of shares of a listed security, and they are kept at $500,000, while the Nasdaq fees come in at around $27,500. So we can understand why the growth type stocks would be found on the Nasdaq exchange. Prior to March 8, 2006, the final major difference between these two exchanges was their type of ownership. The Nasdaq exchange was listed as a publicly traded corporation, while the New York Stock Exchange was private. This all changed in March 2006. The New York Stock Exchange went public after being a not-profit exchange for nearly 214 years. Most of the time, we think of the Nasdaq and New York Stock Exchange as markets or exchanges, but these entities are both actually businesses providing a service to earn a profit for shareholders. The shares of these exchanges, like those of any public company, can be bought and sold by investors on an exchange. As publicly traded companies, the Nasdaq and the New York Stock Exchange must follow the standard filing requirements set out by the Securities and Exchange Commission. Now that the New York Stock Exchange has become a publicly traded corporation, the difference between these two exchanges are starting to decrease, but the remaining differences should not affect how they function as marketplaces for equity traders and investors. The bottom line, both the New York Stock Exchange and the Nasdaq markets accommodate the major portion of all equities trading in North America, but these exchanges are by no means the same. Although their differences may not affect your stock picks, your understanding of how these exchanges work will give you some insight into how trades are executed and how a market works. In Dar es Salaam City, James Florida, wBase Business News.